On the morning of December 8, 2005, a trader at Mizuho Securities tried to sell 41 times the total number of shares that actually existed. The Tokyo Stock Exchange processed the order anyway. When Mizuho tried to cancel, the order kept running. What the Tokyo District Court would later conclude about the why is the second half of the story. By the end of the morning, one of Japan's largest brokerages had lost approximately 40.7 billion yen, around $340 million, in one morning. Mizuho Securities was the brokerage arm of Mizuho Financial Group, one of Japan's largest banking conglomerates, the kind of institution that executed routine orders thousands of times a day without incident. On December 8, 2005, one of those orders was not routine. What happened next took minutes. The consequences took years. The company at the center of it was called JCOM Co., a Japanese staffing services firm. December 8th was its first day of trading. It was an ordinary IPO morning. When a trader instructs a brokerage to sell shares, they enter two things: a quantity, how many shares to sell, and a price, what to sell them for. In this case, the correct instruction was sell one share of JCOM at 610,000 yen. The trader entered sell 610,000 shares of JCOM at 1 yen. The two fields, price and quantity, had been transposed. 1 yen is less than 1 US cent. The intended price was 610,000 yen, roughly the monthly salary of a mid-career professional in Tokyo. Imagine you list your apartment for rent at $1 per month instead of 1,000. Except the listing goes live instantly. Contracts are signed within seconds by people who spotted the price before you did, and the platform tells you it cannot be undone. The order was sent to the Tokyo Stock Exchange. According to the Associated Press reporting at the time, the quantity specified was 41 times the total number of JCOM shares that actually existed. The exchange processed it anyway. JCOM share price, which had opened normally that morning, began swinging violently as Mizuho sell orders flooded the market. Associated Press reported that it fell sharply before being driven upward by buyers moving against the anomaly. The volume coming through the exchange had no relationship to the size of the company. The orders kept coming, and Mizuho could not stop them. When Mizuho realized what had happened, it attempted to cancel the order. According to Mizuho's spokesperson at the time, speaking to the Associated Press the following day, the firm submitted cancellation requests multiple times. The Tokyo District Court, which ruled on this matter 4 years later, found that the Tokyo Stock Exchange's computer system had a technical defect in its cancellation processing. When Mizuho's instructions arrived, the system could not process them. This was not a human decision. The system received the instructions and failed to act. Mizuho attempted to cancel. The system did not process the requests. The system had accepted an order the court would later find it should have flagged, and once it was accepted, it could not be stopped. The Tokyo Stock Exchange suspended trading in JCOM shares in the following morning. The loss to Mizuho Securities, as the full position was unwound in the days that followed, reached approximately 40.7 billion yen, around $340 million at the exchange rate at the time. The market, meanwhile, had already moved on. Mizuho's order had flooded the market with JCOM shares priced at near zero. Other participants bought those shares at a fraction of their actual value. They sold them at market prices. The gap Mizuho's error had created was, for everyone else, an opportunity. According to a Ministry of Finance filing, Morgan Stanley ended the trading day holding a 31.2% stake in JCOM. These counterparties had done nothing contrary to the rules as they existed. In 2006, Finextra reported that approximately 50 securities firms agreed to return a combined 20 billion yen in profits made through those trades. The funds were directed to a program to improve the Tokyo Stock Exchange's trading infrastructure. Those 50 firms had no legal obligation to return anything. They had traded at the prices the exchange itself was processing and accepting. Under the rules as they stood, the profits were legitimately theirs. The decision to return 20 billion yen was voluntary, reached outside any court order before the litigation between Mizuho and the Tokyo Stock Exchange had even concluded. Here is what the public record shows. Japan's Financial Services Agency launched an immediate investigation according to Associated Press reporting at the time. Both the Tokyo Stock Exchange and Mizuho Securities were formally rebuked by the Japanese government. Japan's Prime Minister at the time called publicly for safety measures to prevent a repeat. The specific gap the incident had exposed, an order accepted without any validation of whether the quantity exceeded the shares in existence, was addressed by the exchange. In December 2009, 4 years after the trade, the Tokyo District Court ruled. The case was, according to Associated Press reporting, the first ever court dispute between the exchange and one of its member brokerages. The court found that the Tokyo Stock Exchange's trading system had a defect, and that exchange bore significant fault for failing to halt a transaction it had identified as anomalous. It assigned 70% of responsibility to the Tokyo Stock Exchange and 30% to Mizuho Securities. Including accrued charges, the Tokyo Stock Exchange made a payment of 13.2 billion yen to Mizuho in December 2009. The Tokyo High Court upheld the ruling on appeal in 2013. Mizuho claimed 41.5 billion yen. It received 13.2 billion. 28 billion yen of that legal claim stayed permanently uncovered by the court. One keystroke, one system that could not cancel. 40.7 billion yen. 41 times the shares that existed. Make of that what you will.